Hi everyone, so welcome to Investing for Value. So Lyft just released their results, and it's not too bad. Like revenue's gone up 52%, while losses have gone up from a year prior. If you adjust it for non-cash items, it's actually just about 130 million in losses, which isn't too bad given how things are running. And especially since this is their first billion-dollar quarter, so quite a good milestone. But how did things go on for the whole year? So we've got the finance fiscal year numbers. So 2008 revenue numbers were 2.2 billion, but that's gone up to 3.6 billion, so quite impressive, 68% growth. So mind you, here it's actually at 50. Last quarter was 52%, so they've been actually going a lot quicker at the start of last year rather than at the end of the year. So we can see these are going to be slower as it goes. And then we look at the losses have been stemmed quite a percent amount, 889 million to 652 million. So quite a big change as they're going for profitability, especially now that Uber's going for profitability. Lyft has a lot more pressure to go to profitability as well. So in terms of outlook, how's the outlook going? The outlook is they expect to continue these billion-dollar quarters from now on. They're going to be growing about 36% quarter. Like as I say, prior to that, the start usually goes quicker than the end. Um, and the loss for that quarter, for the next quarter, will be about 140 to 145, adjusting for non-cash items. So it just helps to look at the how much they're losing in terms of real cash, rather than say looking at non-cash items that just don't have as much impact. If you issue like shares to employees and you call it a cost, the impact isn't as bad, because at the end of the day we're trying to go, what's your burn rate in terms of the cash going out the door and how much cash you have. They have about $2.9 billion. So when you're like losing about 100 and 150 or something, not even 150, but round about 150, then it's not bad. It means you have a large run rate. Like they expect your losses to be about 450 to 490, which is quite a bit lower than here, about 200 million lower. So which is quite a good sign that they're able to start reducing their losses. Though we're looking at a big slowdown in growth. So their revenue is expected to be $4.5 billion. Though growth from that is about 27 to 29%, which is a far cry from 68%. And even and if we look at the prior quarter, it was at 52%. So the growth has slowed, like it's just slowed like immensely. Considering Uber's just been growing their last financial year about 37% or around about there. It's quite a big difference. Like it means Lyft is now growing slower than Uber. Uber is going to be profitable in about a year's time, whereas Lyft is probably going to take another 2-3 years. They don't expect profitability this year, and they potentially expect it at the very end of next year. So then they can basically look at 2022 as being a potential profitable year, assuming they've actually looked at that competition could get tougher. So when these guys are giving out growth, it means players like Uber have just basically have the advantage after that. So I'd say like this kind of confirms what I was thinking in my last video, where I was like, will you buy Uber, will you buy Lyft? And well, if you look at the current situation, Uber has by far the strongest position, by far the most diverse position as well. So in terms of risk, Lyft is a bit higher in risk. Share price is 53.94, giving a market valuation of $16 billion. So, and given the growth rates kind of dropped off quite a bit, I expect the market value to drop, to adjust for it, because if like usually companies do not grow quicker after they've slowed down, especially if they're chasing profitability. They just can't keep shoveling money out the door. So when we're looking at 27% growth, well, in an essence, basically the year after that they're looking at about just over 6 billion in revenue. And then if losses keep, like the minute you've like slowed down revenue growth, then the money that you can make for profit ends up being a lot lower. So this loss for the year after that, it would be about, if we reduce it by another 200 million, about 250, and then that's why I think that a year after maybe they can keep reducing their losses and then they'll be just profitable in a very minor way because they're not growing it. They can't. There's not a lot of area that they can get their profits from. So even if you were profitable, the profit amount isn't going to be very large. Like if Uber made a profit, we're talking like hundreds of millions. We're talking it'll get into the billions very quickly. But these guys, if they get profitable, it'll start in the tens of millions, then it'll work itself in the hundreds of millions over like a couple of years. So like when you look at the market value, it's actually quite high for what you're expecting now. Now that growth has kind of dropped, and it's the kind of the largest risk about investing in growth companies, because the minute growth drops off, the value just drops off very quick after that. So in terms of my opinion anyway, I think the market value is going to drop quite a bit from here, given that things are just beginning to slow down. Like, I mean, it's great, that they're targeting profitability, though, at the end of the day, like, people got into this company because it was a growth company, it was pioneering, the way for, ride sharing, and then also self-driving. So you never know. Self-driving might be a game changer for them, though Tesla's also entering the self-driving aspect. So when Tesla comes in, this company's going to face a bit more competition. Though I thought this was quite nice. 100,000 rides on self-driving that were paid with, they've done it with Active. And that's by far the in terms of commercial rides, Lyft has been ahead in that game, though I expect everyone just to come in and catch up quite quickly. So those are my thoughts about the company. That firstly, the fourth quarter was pretty decent. The financial year wasn't too bad either. Though the losses, if we're focusing on the losses, they do have to put a bit more effort in there. They have 3 billion in the bank, so I think they probably should just keep chasing growth. To be honest, keep this up, keep this loss up. You don't have If you start reducing your losses, you're giving up like incentives. You're not trying to entice people to take your ride service anymore. Not as much as not in terms of like not more than say like Uber or something like that. So now they are competing on a very similar ground. If Uber was to give more incentives, then easily Uber can basically start outpacing Lyft in terms of a lot of destinations. Lyft kind of sees a lot of their growth coming in from bikes and scooters, so they're trying to make advantage of that. Though, yeah, I think in terms of this, like this basically seals the fate that Lyft isn't going to be a large player. They're just going to be they're kind of like a minor type player as they go. Like I mean, like in terms of in comparison to Uber, right? They're still fairly large in their own right. Though the minute you start closing down growth, you've kind of like determined how large you're going to be in a sense. So I think for Uber, this means a huge advantage, particularly if your competitor is slowing down growth and not being as aggressive. So this is kind of what I was kind of alluding to in the last video, where you basically have two companies who are competing neck and neck, but now that they want to chase growth, well, not growth, they want to chase profitability. Now that they want to chase profitability, things are slowing down. They can up their pricing, and then now they can basically both be profitable. Though Uber's going to be immensely profitable compared to Lyft. But yeah, like those are what I think anyway, and I won't try to keep this video over too long because I think the last one was really long. So let me know what you guys think. If you've got any other stocks, also let me know. It's always good to just look at different opinions, share perspectives, and for Lyft, I think things like probably I wouldn't advise investing in Lyft right now, unless things were to really change. So yeah, like from the other video, if you're gonna choose between Lyft or Uber, I'd say you choose Uber. Lyft isn't offering. Uh, Lyft is really on a borderline of a growth stock now. Like with growth stocks, usually I look at if they're around about 20% plus in terms of growth. That's like borderline growth for me. And currently, Lyft is in the borderline, and this is just a forecast. This isn't determined as real numbers. If say like Tesla decides they want to start offering ride sharing, or Uber decides to get even more competitive, since they've seen that Lyft is retreating in a sense. They're sort of retreating. Uber might just see it as the chance to just go on the offensive and even take even more market share. This revenue number could even be a little lower. So there's a bit of risk there when you start to retreat, because what's the best defense in terms of this kind of game? It tends to be offense, right? So now that you get rid of offense, your defense is even weaker. Though it doesn't start with a strong position, especially when you're on high losses. So investors are going to be judging them. And the thing is, in terms of like, if your growth rate goes down, but your losses go down as well, most investors are either there for profit or for growth. And if you don't have growth and you don't have profit, it's not a good frame to be in. So that's kind of my thinking around this. But let me know what you think. Until then, good luck investing.